Tesla just lost everything, and nobody saw it coming. The company that once ruled the electric vehicle world has collapsed in a way no one could have predicted. In less than 90 days, Tesla's stock plummeted by over 50%, erasing hundreds of billions of dollars from its market value. Europe, once Tesla's most profitable stronghold, has turned against it, and Wall Street is fleeing like never before. And at the center of this chaos, Elon Musk himself, whose controversial moves might have set off the chain reaction that brought Tesla to its knees. This isn't just a business blunder, it's a seismic shift that's leaving investors, consumers, and the entire automotive world in shock. So how did Tesla's brightest moment become its darkest hour? Why did Europe flip from fan to foe? And can Musk still steer his company out of this storm? Stick around, because the truth behind Tesla's collapse will change how you see the future of electric vehicles. Europe's revenge. The electric vehicle empire falls. What if Tesla's biggest success became its greatest downfall? For years, Europe had been Tesla's most successful international market. From 2018 to 2022, Tesla dominated the electric vehicle landscape across the continent. In countries like Germany, France, and Italy, Tesla's sleek designs, advanced technology, and the magnetic appeal of Elon Musk made it the preferred brand for forward-thinking consumers. Tesla showrooms across Europe were buzzing with activity, and the company's Gigafactory in Berlin was celebrated as a milestone in local production. The company's presence in Europe symbolized a new era of sustainable transportation, positioning Tesla as not just an automotive leader, but a cultural phenomenon. However, this seemingly unshakable position crumbled in just a few months. The turning point came when President Donald Trump's aggressive tariff policies set off a wave of economic retaliation from Europe. These tariffs targeted imported automotive components, including those critical to Tesla's production lines. The backlash from European leaders was swift and fierce, as they saw the tariffs as a direct assault on economic cooperation. Tesla, as one of the most visible symbols of American automotive success, became an unintended casualty of this political conflict. The tariffs not only increased the cost of production, but also stirred public sentiment against American brands, making Tesla an easy target for consumer discontent. The numbers told a grim story. In Germany, which had been Tesla's largest market in Europe, sales plummeted by 73% in the first quarter of 2025 compared to the previous year. France saw a 66% decline, while Italy reported a dramatic 70% drop. These were not slow declines. They were abrupt and severe, reflecting a complete shift in consumer attitudes toward the brand. Surveys conducted by European Auto Watch indicated that over 60% of former Tesla owners cited a negative brand image and loss of trust as the main reasons for switching to other manufacturers. The primary factors were rising prices linked to tariffs, Musk's controversial political comments, and growing resentment toward American economic policy. This sentiment was further fueled by local media, which portrayed Musk as an outsider who failed to respect European values. And just when it couldn't get worse, Wall Street entered the chaos. We've done the research, analyzed the data, and uncovered the facts behind Tesla's collapse. If you're finding this breakdown valuable, make sure to like the video and subscribe to the channel. Financial inferno, the unseen domino effect. Tesla didn't just stumble, it crashed, taking billions with it. The financial fallout from Tesla's collapse was not just a localized issue confined to the company or its investors. It reverberated through global markets, creating a ripple effect that took down other sectors along with it. Tesla's market capitalization, which once stood at an impressive $770 billion at the beginning of the year, plummeted to just $360 billion by March. This rapid decline marked a loss of more than $400 billion in shareholder value. The shock was so profound that even seasoned investors who had previously weathered major market crashes found themselves caught off guard. Major institutional investors, including some of the world's largest hedge funds and pension plans, scrambled to minimize their losses. Companies like BlackRock and Vanguard, which had long considered Tesla a cornerstone of their technology and automotive portfolios, suddenly began offloading shares at unprecedented rates. The decision to sell was not purely speculative. It was driven by the hard reality of margin calls. As Tesla's stock price kept dropping, investors who had bought shares on leverage were forced to sell off their holdings to cover debts. Automated trading systems, designed to cut losses when prices fall, exacerbated the situation, triggering more sell-offs in a cascading loop of panic. The domino effect did not stop with Tesla's direct investors. Many financial institutions had tied their funds to Tesla's performance, and as the company's value plummeted, these funds also suffered significant losses. Mutual funds heavily invested in Tesla saw their overall returns shrink dramatically. For small investors who had put their faith in Tesla's long-term vision, the experience was nothing short of catastrophic. One retail investor who had put his entire retirement savings into Tesla described his situation as a nightmare. "I trusted the brand. I believed in the mission. Now I am left with almost nothing." Financial analysts warned that the fallout from Tesla's collapse could extend beyond the automotive sector, as the company had positioned itself not just as a car manufacturer, but as a technology innovator. Other tech stocks also took a hit. Companies that supplied Tesla with crucial components, like battery manufacturers and semiconductor suppliers, saw their stocks dip as well. The fear was that if Tesla could fall so quickly, other tech-driven companies might be similarly vulnerable to economic and political shifts. The situation grew dire enough that credit rating agencies like Moody's and Standard & Poor's downgraded Tesla's bonds, labeling them as higher risk than before. This downgrade made borrowing more expensive for Tesla at a time when the company needed liquidity to navigate the crisis. The downgrade also sent a clear signal to the market. Tesla was no longer seen as a sure bet. Analysts on financial networks openly questioned whether Tesla's business model, which had relied on premium pricing and futuristic branding, could withstand such a dramatic loss of public confidence. But the fallout wasn't just about Musk, it was about Trump's policy. Trump's tariffs, Tesla's Achilles heel. Trump wanted to protect American jobs, but Tesla paid the price. In an ambitious move to revive American manufacturing, President Donald Trump's administration imposed sweeping tariffs on imported automotive components. These tariffs aimed to reduce reliance on foreign goods and encourage domestic production, but they inadvertently ensnared one of America's most innovative companies, Tesla. The electric vehicle giant, known for pushing the boundaries of automotive technology, found itself trapped by policies that were meant to strengthen American industry. The core issue lay in the specific components targeted by the tariffs. In early 2025, Trump signed an executive order imposing hefty tariffs on automotive parts imported from key trading partners, including Europe and China. The targeted materials were essential to electric vehicle production: lithium, cobalt, nickel, and high-tech electronic components. These elements faced tariffs as high as 35%, dramatically increasing costs. Tesla, which relied on global supply chains to source the best components at competitive prices, suddenly faced a massive financial strain. Tesla's production costs skyrocketed. With no viable domestic alternatives for many of these raw materials, the company had to either absorb the increased expenses or pass them on to consumers. Absorbing the costs meant operating at a loss, while raising vehicle prices risked losing the competitive edge Tesla had worked so hard to establish. To mitigate the impact, Tesla attempted to renegotiate contracts with suppliers, but many refused to budge, citing their own increased costs from the tariffs. The financial pressure on Tesla intensified, with each production run costing significantly more than planned. The tariffs did more than just increase costs, they also disrupted the entire production schedule. Components that once flowed smoothly from Asia and Europe into Tesla's gigafactories now faced customs delays and increased scrutiny. In some cases, shipments were held up for weeks, causing production lines to halt. Tesla's Berlin factory, in particular, faced logistical nightmares as key components from Asia arrived weeks late. Instead of producing cars at the planned rate, the factory struggled to keep up with demand, leading to back orders and growing customer frustration. Investors reacted poorly to the mounting challenges. Many had placed their faith in Tesla's ability to maintain its growth trajectory, and the sudden spike in production costs shattered that confidence. Financial analysts warned that the company's slim profit margins made it especially vulnerable to economic shocks like this. One investment manager noted, "Tesla's business model works when production is efficient and predictable. These tariffs have completely disrupted that balance." As the company's stock continued to decline, Musk's public support for the tariffs only deepened the divide between the brand and its customer base. And as international tensions rose, Asia made its move. Asia strikes back: how the East won the EV battle. China didn't just retaliate, they declared economic war. In response to Trump's tariffs, China and South Korea crafted countermeasures aimed directly at American companies, with Tesla being one of the primary targets. The retaliation was swift and calculated, designed not only to hurt Tesla's bottom line, but also to assert economic dominance in the rapidly growing electric vehicle market. As the world's largest EV market responded first, it imposed additional tariffs on American-made electric vehicles and automotive parts, specifically targeting Tesla's Shanghai Gigafactory. These tariffs ranged from 15 to 25%, significantly increasing the cost of producing cars domestically and for export. Moreover, Chinese regulators ramped up inspections under the guise of quality assurance, causing production delays. Reports surfaced that customs officials were intentionally slowing down the processing of Tesla parts to create a bottleneck in the supply chain. As a result, the Shanghai factory's output dropped by nearly 40%, causing delays in deliveries both within China and abroad. South Korea took a slightly different approach, leveraging safety and environmental regulations to hamper Tesla's operations. New certification requirements specifically targeted Tesla's battery technology, demanding additional safety evaluations. These standards, which did not apply as stringently to domestic brands, forced Tesla to halt production temporarily to comply. The delays not only affected sales, but also gave local competitors like Hyundai and Kia the opportunity to dominate the market with less regulatory interference. Asian competitors seized the opportunity with precision. BYD and NIO ramped up production, marketing their electric vehicles as reliable, affordable, and politically neutral. They emphasized their stability in contrast to Tesla's ongoing struggles. European consumers, already disillusioned with Tesla's pricing and political controversies, found the Asian alternatives more appealing. Sales of BYD and NIO vehicles surged by 20% in just 3 months, with many former Tesla owners making the switch. The strategic counterattack from Asia not only hurt Tesla financially, but also reshaped consumer perceptions. Where Tesla was once seen as the undisputed leader in electric innovation, it was now portrayed as a vulnerable company caught in a geopolitical tug-of-war. The Chinese government, recognizing Tesla's weakened position, encouraged consumers to support local brands as a matter of national pride. This coordinated push left Tesla scrambling to retain its foothold in the region, and while Tesla battled logistics, public outrage was boiling over. The protest wave. When consumers and workers rebel. When your fans become your foes, you know you've lost the battle. As Tesla's reputation crumbled, protests erupted in both Europe and the United States. In Berlin, factory workers staged walkouts, demanding better wages and safer working conditions, especially after Musk's political statements strained local relations. In France, environmental activists criticized Musk's support of tariffs, accusing him of compromising Tesla's sustainability ethos for political gain. In the U.S., workers at Tesla's factories in Texas and Nevada also joined the protests, citing long hours, stagnant wages, and unsafe conditions worsened by production pressure. Union organizers saw an opportunity to galvanize workers, pushing for better labor practices. As investors fled, Tesla's cultural image was collapsing even faster. The cultural shift. Tesla becomes a pariah. How does a beloved brand become a public villain overnight? Tesla, once hailed as a symbol of innovation and a force for sustainable change, was now seen as a cautionary tale. The public perception of Tesla did not just shift, it flipped completely. Following the financial implosion, it became increasingly clear that the problem was not just about numbers on a balance sheet. It was about the way Tesla had gone from being admired to being reviled, almost overnight. The transformation began when Elon Musk's controversial comments made headlines worldwide. Instead of showing leadership in a time of crisis, Musk lashed out on social media, defending Trump's tariffs and disparaging European leaders as outdated bureaucrats. Media outlets that once celebrated Musk's entrepreneurial spirit now labeled him as reckless and out of touch. Headlines screamed about Tesla's downfall, not as a business tragedy, but as a moral failing, driven by arrogance and hubris. Social media became the epicenter of backlash. Twitter and YouTube were flooded with debates about Musk's behavior, with hashtags like "Yes, boycott Tesla" and "Musk Madness" trending globally. Once loyal fans were now openly criticizing Musk, questioning his judgment and leadership. A former Tesla owner posted, "I used to feel proud driving my Model S. Now I feel like I'm being judged for supporting Musk's ego." The narrative had shifted from admiration to disdain, and it was clear that Musk's controversial stances had alienated a significant portion of his fanbase. Surveys conducted in Europe and North America revealed a stark decline in public approval of Tesla. In Germany, a former stronghold, over half of those surveyed said they would no longer consider buying a Tesla due to the company's association with divisive political rhetoric. In the United States, Tesla's reputation as a symbol of progress took a hit as consumers voiced concerns about Musk's increasingly erratic behavior. The cultural impact was undeniable. Tesla was no longer the cool, forward-thinking brand it once was. While the public turned its back, Tesla's competitors saw an opportunity. Competing giants. Why Hyundai and Volkswagen are winning. When a giant falls, others rise to take its place. As Tesla's reputation and market value crumbled, rival automakers sensed an opportunity to dominate the electric vehicle market. Volkswagen and Hyundai in particular moved swiftly to fill the void left by Tesla's rapid decline. Their strategies were not just reactive, they were calculated moves to secure a foothold while Tesla faltered. Volkswagen ramped up its marketing, positioning its ID.4 as the reliable and affordable alternative to Tesla's high-priced models. Meanwhile, Hyundai emphasized the practicality and dependability of its Ioniq series, targeting consumers disillusioned by Tesla's controversies. Both brands took a distinctly local approach, emphasizing European and South Korean craftsmanship over American brashness. Their message was clear: dependable, drama-free innovation. In Germany, consumers flocked to Volkswagen dealerships, drawn by the appeal of supporting local manufacturing. Reports indicated that many former Tesla owners opted for Volkswagen's electric SUVs, appreciating their practical features and the absence of political baggage. In South Korea, Hyundai's domestic appeal grew stronger, bolstered by marketing that subtly hinted at Tesla's instability. Hyundai's customer support, known for being responsive and reliable, became a key selling point against Tesla's often criticized service model. Just when it seemed like the collapse couldn't deepen, Tesla faced a new wave of internal rebellion: the global trade realignment. EV markets without Tesla. Tesla's collapse didn't just shake the company, it shook the global electric vehicle market. The automotive world had long considered Tesla the uncontested leader in electric mobility. Its sleek designs, cutting-edge battery technology, and charismatic leadership made it more than just a car company. It was a symbol of the future. However, as Tesla's dominance faded, the ripple effects were felt far beyond its corporate walls. The collapse did not just signify a downfall for one company, it marked a turning point in the global electric vehicle landscape. As Tesla's market share plummeted, European and Chinese automakers seized the opportunity to expand. Companies like Volkswagen, Renault, and Hyundai, which had been steadily investing in electric mobility, saw Tesla's crisis as a chance to solidify their positions. In Europe, where consumers were increasingly wary of Tesla due to political controversies and Musk's erratic behavior, local manufacturers doubled down on their electric vehicle offerings. Volkswagen introduced new models specifically designed for the European market, highlighting affordability, local production, and long-term reliability. The strategy worked as sales of the Volkswagen ID.4 surged, while Tesla's Model Y languished in showrooms. Meanwhile, Chinese automakers like BYD and NIO made aggressive moves into the European market. Backed by government subsidies and a reputation for cost-effective electric vehicles, these brands appealed to consumers looking for practical alternatives to Tesla. BYD's focus on affordable, long-range electric vehicles resonated particularly well in Germany and France, where consumers had grown weary of Tesla's price hikes and political baggage. NIO, known for its battery-swapping technology, introduced innovative service models that made electric vehicle ownership more convenient. As Tesla struggled, these competitors quickly filled the gap, and within months, Tesla's once dominant market share had been sliced in half. The realignment of the electric vehicle market also involved significant changes in trade policies. As Tesla's influence waned, new trade agreements emerged that favored local production and reduced dependence on American imports. European Union leaders pushed for regulations that incentivized electric vehicle manufacturers to produce within the continent. This strategy not only reduced reliance on foreign components, but also made locally produced vehicles more competitive against American imports, burdened by tariffs. In China, the government supported domestic brands by offering tax breaks and subsidies, further strengthening the position of local automakers. Tesla's fall also meant a loss of its previous role in shaping electric vehicle standards and innovations. For years, Tesla's battery technology and autonomous driving systems had set benchmarks for the industry. However, as its influence dwindled, other companies began pushing their own technological standards. Volkswagen's MEB platform, designed for modular electric vehicle production, gained traction as a new industry standard. In China, BYD's Blade battery technology emerged as an efficient and safer alternative to Tesla's lithium-ion cells. As these innovations took center stage, Tesla's proprietary systems began to look increasingly outdated and less versatile. And while Tesla's market position crumbled, internal challenges were boiling over, threatening the company from the inside. Internal chaos. Why Tesla employees are revolting. When your workforce turns against you, survival becomes almost impossible. As Tesla's stock plummeted and consumer confidence faltered, the company faced an even more dangerous threat from within, its own employees. Discontent had been simmering for years, but as financial instability worsened, worker frustration erupted into open rebellion. What started as whispered complaints grew into organized protests and walkouts, signaling a full-scale internal crisis. Workers at Tesla's gigafactories, both in Europe and the United States, expressed growing frustration over stagnant wages and unsafe working conditions. In Berlin, employees protested outside the factory gates, demanding fair pay and better safety protocols. The tension only heightened when Musk, instead of addressing their concerns, doubled down on his controversial political statements. In Nevada and Texas, where production lines were already strained due to supply chain disruptions, workers complained of excessive overtime and lack of hazard pay. Musk's social media presence, once seen as bold and unfiltered, now appeared disconnected from the struggles of the very people building Tesla's cars. The push for unionization gained momentum as more workers saw collective action as the only way to force change. In Berlin, the local metalworkers union held meetings to discuss forming a dedicated Tesla workers committee. In California, where Tesla had previously resisted union efforts, workers staged spontaneous walkouts, frustrated by management's lack of response to their concerns. One assembly line worker remarked, "We work day and night to make these cars, and we get silence from leadership. It's like we don't matter." Musk's behavior increasingly alienated even his most loyal employees. Some senior engineers and project leads publicly criticized his lack of focus on internal issues, pointing out that his obsession with political battles had left workers feeling unsupported. As rumors of layoffs began circulating, morale hit an all-time low. The perception that Musk was more interested in Twitter feuds than addressing operational challenges only deepened the divide between leadership and the workforce. The consequences of the internal revolt were immediate. Production slowed as more workers participated in walkouts. Quality control issues became more frequent as understaffed lines struggled to keep up with quotas. Customer complaints about delayed deliveries and faulty components increased, further eroding Tesla's reputation. Internally, managers found it increasingly difficult to motivate teams who felt abandoned by the company's top leadership. While employees demanded change, the government was preparing to take a closer look at Tesla's stability. The political quake, Tesla's loss of government support. When the government calls you a risk, investors listen. As Tesla's internal issues spilled into public view, the U.S. government took a stance that sent shockwaves through the financial world. In a press conference, the Commerce Secretary declared that Tesla's instability posed significant economic risks. The statement marked a rare instance of a U.S. official publicly questioning the viability of a major American corporation. Government scrutiny intensified as reports surfaced about Tesla's financial instability and employee unrest. Federal regulators began examining whether Tesla's practices violated labor laws or posed threats to economic stability. Lawmakers voiced concerns about federal subsidies granted to Tesla, questioning whether taxpayer money should support a company facing such turmoil. Political commentators noted that Musk's increasingly erratic public behavior had strained the company's relationship with policymakers. Tesla's potential loss of government contracts became a focal point. Analysts predicted that federal funding for sustainable initiatives might be redirected to more stable competitors. As Tesla's stock continued to plummet, losing government support threatened to push the company even closer to financial collapse. The warning was clear. Tesla was no longer seen as a reliable partner in the nation's transition to clean energy. The road ahead. Can Tesla survive the implosion? Tesla isn't just fighting to survive, it's fighting to stay relevant. As the dust settles on a catastrophic year, the big question remains: can Tesla recover from this unprecedented collapse? Elon Musk faces the daunting daunting challenge of not only stabilizing his company, but also rebuilding its shattered reputation. Some experts suggest that a leadership change could be the first step toward recovery. Musk, once hailed as a visionary, now seems more like a liability. Appointing a new CEO could signal a fresh start. Others argue that Tesla must return to its core strength, innovating in electric mobility. A new model, priced competitively, could reignite consumer interest. Rebuilding trust will be the hardest challenge. Can Tesla regain its status as a leader, or will it become a cautionary tale in the electric vehicle revolution? Only time will tell. The Tesla story is far from over, and we're committed to following every twist and turn. What do you think? Is this the end of an era for Elon Musk, or can Tesla make a comeback? Drop your thoughts in the comments below. And if you're into deep dives like this, hit subscribe and join us for more stories that break down the biggest moments in tech and business. Thanks for watching.